Famous investor Charlie Munger used to say, "Tell me where I'm going to die so I won't go there." This way of thinking is called inversion. Inversion helps to look at worst case scenarios and avoid them. Today, we are going to look at 6 different factors or things you need to avoid while investing in stocks or shares of companies. Whether you're a beginner or an experienced investor, these would help to keep away from bad investments or stocks. So let's dive in. I am Palani Munisamy, a technologist turned investor and an early retiree. I have been investing in the US stock market for more than 20 years now. I share my experiences in this channel, Compound and Grow. Please note that I am not a financial advisor. Please do your own due diligence before investing. Before we dive into the material, please take a minute to like and subscribe to this channel so that this material reaches more people like you. Now let's look into 6 different things that you need to avoid while picking individual stocks. Number 1, anemic sales and earnings growth. Sales and earnings growth are foundational elements that move stock prices up. As earnings or profits grow year over year, the P by E ratio comes down, making the stock more attractive in the market. Then the demand for the stock increases and that pushes the stock prices up. So it is very critical to stay away from companies that have very weak or anemic sales and earnings growth. Just to put some numbers around, the mega cap stocks like Microsoft or Apple should have high single digit revenue growth and earnings growth more than 15%. When you come to mid and small cap stocks, the sales and the earnings growth have to be even higher. Number 2, companies with no long-term competitive advantage or moat. As you know, the S&P 500 index in US includes top 500 companies in the index. The average tenure of companies in S&P 500 index was 33 years in 1965. This means a good company selected into S&P 500 index would stay in that S&P 500 index for 33 years. In 1990, it dropped from 33 years to 20 years and is expected to drop to 14 years by 2026. This means a great S&P 500 company that you invest could become irrelevant in the next 12 to 14 years. So it is very critical to look for companies that have strong competitive advantage or moat. In other words, stay away from companies that don't have great competitive advantage and moat. Coming to third one, high debt ratio. It is generally a good investment practice to avoid or stay away from companies that have high debt or highly leveraged. Debt is like some sugar in the coffee. A little sugar makes coffee taste great. Overusing sugar doesn't make coffee any better. In the same way, a reasonable debt provides growth opportunities for the company. High debt ratio could be a big burden for companies, particularly during recessions and a high interest environment like the one we see now. So look for companies with manageable debt level. A debt equity ratio of less than 1 is advisable, but in some capital intensive companies, the debt equity ratio could be as high as 2. Fourth one is low ROIC. Return on invested capital, ROIC, is a crucial metric for the companies. This metric is an indication of how much return a company makes for every dollar that company invests in. A high ROIC is better. So avoid companies that consistently have very low ROIC. ROIC, anything above 20% is great. So look for companies that consistently generate more than 20% ROIC every year. Alright, the fifth one is capital intensive business. A capital intensive business requiring ongoing investments in assets may be less attractive to the investors in the stock market. So stay away from companies that are highly capital intensive. Sixth and final one, no institutional investors. The institutional investors like Fidelity, Vanguard, and others do extensive research on companies before they start investing. If a company lacks such institutional investors, those companies could be little risky. So stay away from companies that do not have significant investment from institutional investors. In conclusion, when it comes to investing, it is essential to know what to avoid more than what to look for. Remember, investing is a long-term game. So take your time to learn and make informed decisions. If you found this video useful, don't forget to hit like button and subscribe to our channel Compound and Grow. Thanks for your time today, and we will see you in the next episode.